Have you been dreaming of owning your first car, but don't have enough savings to pay the full amount upfront? The good news is, you don't have to. A car loan, also known as an auto loan, allows you to purchase a new or used car by paying only a small down payment, while a bank or financial institution finances the remaining amount. But here's the important part. Choosing the wrong loan can cost you thousands in extra interest and hidden charges. So how do you choose the right lender? How do you compare interest rates? What documents do you need? And what mistakes should you avoid? In today's video, we'll answer all these questions in simple, easy to understand English. By the end of this video, you'll know exactly how to apply for a car loan like a smart buyer. Let's begin. What is a car loan? A car loan is a secured loan offered by banks, NBFCs, and financial institutions to help people purchase a vehicle. The lender pays most of the vehicle's price, while you repay the borrowed amount through fixed monthly installments, known as EMIs. Until the loan is fully repaid, the lender has a legal claim on the vehicle. Once all EMIs are paid, the car becomes completely yours. How does a car loan work? Let's understand this with a simple example. Suppose you want to buy a car worth Rs 12 lakh. You pay Rs 2 lakh as a down payment. The bank finances the remaining Rs 10 lakh. If the interest rate is 9% per year and the repayment period is 5 years, you'll repay the loan through 60 monthly EMIs. Each EMI includes a portion of the principal loan amount, interest charged by the lender. After the final EMI, your loan is completely closed. Benefits of taking a car loan. There are several reasons why millions of people prefer financing instead of paying the full amount. First, you can own your dream car immediately without waiting years to save enough money. Second, monthly EMIs make the purchase much more affordable. Third, lenders offer flexible repayment periods, usually ranging from 1 to 7 years. If you have a good credit score, you may qualify for lower interest rates. Paying your EMIs on time also helps improve your credit history, making future loans easier to obtain. Who can apply for a car loan? Most lenders have similar eligibility requirements. Applicants should generally be at least 21 years old. The maximum age at the end of the loan tenure is usually between 65 and 70 years. Both salaried employees and self-employed individuals can apply. Business owners, professionals, and freelancers with stable income may also qualify. A good repayment history and a healthy credit score significantly improve your chances of approval. Documents required to process your application. Lenders usually ask for the following documents. Identity proof, Aadhaar card, PN, card, passport, driving license, address. Proof, Aadhaar card. Utility bill, passport, rental agreement, income. Proof, salary. Slips, bank statements, Form 16. Income tax returns. Business financial statements, vehicle documents, dealer. Quotation, pro forma invoice, vehicle details. New car loan versus used car loan. New car loans generally come with lower interest rates, higher financing limits, and longer repayment periods. Used car loans usually have slightly higher interest rates, lower financing amounts, and shorter repayment terms. If your budget allows, financing a new car often provides better loan benefits. How to check car loan interest rates before applying? Never rely on just one lender. Start by visiting the official websites of banks and financial institutions to check their latest interest rates. Compare multiple lenders based on PE, interest rate processing fee, loan to tenure monthly, EMI foreclosure charges, prepayment charges. Most banks also provide free EMI calculators. Simply enter the loan amount, interest rate, and repayment period to estimate your monthly EMI instantly. Also look for festive offers, cashback promotions, or discounted processing fees that can reduce your overall borrowing cost. Fixed versus floating interest rates. Many buyers get confused between these two options. A fixed interest rate remains the same throughout the loan period. Your EMI never changes, making budgeting easier. A floating interest rate changes according to market conditions. Your EMI may increase or decrease depending on interest rate movements. If you prefer stable monthly payments, a fixed rate is usually the better choice. Factors that affect your interest rate. Lenders calculate your interest rate based on several factors. A higher credit score generally results in lower interest rates. Stable monthly income improves your eligibility. Existing loans and outstanding debt may increase your borrowing cost. The loan amount and repayment period also influence the final rate offered by the lender. Tips to increase loan approval. If you want faster approval, follow these simple tips. Maintain a good credit score. Pay all credit card bills and existing EMIs on time. Avoid applying for multiple loans at the same time. Choose a loan amount that matches your repayment capacity. Keep all required documents ready before applying. Having stable employment or regular business income also improves your approval chances. Hidden charges. You should check. Many buyers focus only on the interest rate. However, several additional charges can increase the total loan cost. Always check for TSA, processing fee, documentation charges, late payment penalty, foreclosure charges, part payment charges, insurance costs, GST on applicable fees. Read the loan agreement carefully before signing. Common mistakes to avoid. Many first-time buyers make costly mistakes. Avoid borrowing more than you actually need. Never ignore hidden charges. Don't choose the longest repayment period just because the EMI looks smaller. Always compare multiple lenders before making a decision. Read every term and condition carefully. Most importantly, never miss an EMI as it can negatively affect your credit score. How to choose the best car loan. Use this simple checklist before applying. Compare at least 5 lenders. Look at the total borrowing cost instead of just the interest rate. Choose lenders with low processing fees. Read customer reviews. Understand foreclosure and prepayment rules. Calculate your EMI before submitting the application. Most importantly, select an EMI that comfortably fits your monthly budget. Practical example, imagine 2 banks. Bank A offers a lower interest rate but charges a high processing fee. Bank B offers a slightly higher interest rate but charges no processing fee and allows free foreclosure. In many cases, Bank B may actually cost less over the entire loan period. This is why comparing the total cost of borrowing is much smarter than looking only at the interest rate. Can you repay the loan early? Yes, most lenders allow you to make partial prepayments or close the loan before the repayment period ends. However, some banks charge a foreclosure fee. Always read the loan agreement carefully before signing. If you receive extra income or a bonus, paying off the loan early can reduce the total interest you pay. Final tips. Before taking a car loan, remember these important points. Buy a car that fits your financial situation, not your emotions. Pay a higher down payment whenever possible. Maintain a healthy credit score. Compare offers from multiple lenders. Read every term carefully before signing. Never miss your EMI payments. A well-planned car loan can help you own your dream vehicle without creating unnecessary financial stress. A car loan is one of the easiest ways to purchase a vehicle, but only if you borrow wisely. Take time to compare lenders, understand the interest rates, calculate your EMI, and choose a repayment plan that matches your income. A few hours of research today can save you a significant amount of money over the life of your loan. If you found this guide helpful, don't forget to like this video, subscribe to the channel, and press the bell icon for more easy-to-understand finance guides, smart money tips, loan advice, and investment education. Thank you for watching, and we'll see you in the next video.